It's critical to have a good understanding of margin when trading, especially when trading Forex. We'll start by going through what margin is when trading Forex with example scenarios for each to help you understand it. The idea of using margin is that you can use your money to control a larger position in a market that you otherwise could not. A margin trading account is simply a brokerage account that allows the trader to use money borrowed from a broker to trade. Your margin refers to the amount of equity a trader has in their margin brokerage account. Using margin to make a trade is like using the equity in your account as collateral for a loan. You're borrowing money so you can place a larger position size for your trade or investment opportunity. The required margin is like a deposit, which you will get back once you close out your trade positions. The cost from using margin is the interest cost, which is usually a relatively small amount compared to the size of the trade. Next, we will go through what free margin is. Free margin is the difference between used margin and equity. Therefore, it's simply referring to the equity that's not tied up in open trade positions. Free margin is also sometimes referred to as usable margin, as it's the margin that you can use for new positions. Take a look at the diagram to see how you would work out your free margin. When free margin is at 0, then new positions cannot be entered. This is simple enough to understand, so we'll now move on to what the term margin level means. Since we know what used margin is and how to calculate it, we can also understand what the margin level is. The higher the margin level percentage means the more free margin you have available to trade. Using the example from earlier, where we had two positions open using $5,010 in total from a $50,000 account, we can calculate the margin level. Let's say both positions were at break even, therefore your account equity is the same as your account balance, which is $50,000. The margin level would be $50,000 divided by $5,010, which is 9.98, which we multiply by 100 to give 998%. 998% means the margin level is high, therefore it shouldn't be an issue entering more trades at the same time. The lower the margin level percentage figure means the greater the used margin compared to your equity is. For many brokers, the margin level percentage is limited to no less than 100%. If this is the case with your broker, then you need to be aware of this so you don't use up all your margin. It's important to know that if any of your open positions go into drawdown, then your equity will decrease, and this will impact your margin level. Without a good understanding of margin when trading Forex, you will not understand how to manage risk. Margin not only applies to Forex trading, you can also use margin accounts for stock trading, futures trading, and other ways of trading too. A major appeal of Forex trading is the ability to be able to trade with margin. Despite this, margin trading is still commonly misunderstood, or sometimes completely overlooked by many Forex traders. Margin trading amplifies your returns for better or worse, therefore it's critical you are aware of margin calculations so you can manage risk. If you found value from watching this video, or you'd like to learn more about trading risk management, consider subscribing and click the bell icon for notifications. Also, don't forget to click the like button if you enjoyed it. Until next time.